Welcome back to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And this week, we're continuing our conversation about various retirement vehicles.
Sometimes it's just because all you have is a hammer, everything looks like a nail. So the second somebody talks about taxes, they're like, oh, I can help. I have a tool that helps with that.
Yeah.
They may not even know the full ramifications of this because all they have is the hammer.
These plans shouldn't be designed because of a tax benefit. It should be designed because you want to save up money for retirement in this asset, because that's what it is. It's a retirement account.
All right. Hi, guys. Today, we're continuing our conversation that we started last week about retirement vehicles and what are the ramifications of each, and talking through some things that people just probably don't understand about 401ks and IRAs. And today we're going to go beyond those more traditional ones and talk about what else people can invest for retirement in. So, Bob, where do we want to start?
I guess from the beginning. So yeah, like you had mentioned, Aaron, last episode, we talked about just the traditional, kind of gave a high view, and then we dove into some traditional 401k plans, IRAs. So today, I think we should really just focus on defined benefit plans. And I think this entire episode should be about that. And before we dive into that, I think it's appropriate to just remind everybody that this is for educational purposes only. We are not giving you financial advice. We don't know you. You're a viewer, which is great. And hopefully you're a member, which is great. We can have these conversations offline individually. But all this information is just from a high level perspective to give you some thoughts and tools to be able to go and do your research or reach out to us with some questions that you already have. So what is a defined benefit plan? Well, it is just that. It's a benefit retirement that's defined. It's the formalization of what that definition looks like. And so how do we go about doing that? Well, what is a retirement fund for? It's retirement. So we have to use a data inputs. And the first data input is going to be, when do you want to retire? What age is that? So that's going to be that age of retirement. Now, we're going to have that as our end date, and that's when we're going to start taking out money from our retirement account. Okay. Now, we got to say the other data point is, how old are we now? Okay. So we have retirement age and my current age. And that's a time frame that is part of that equation or that formalization. Okay. It's very important. Why? Because the government has laid out a specific dollar amount that you're allowed to take out of your retirement account for retirement, that maximization. So what's going to happen is that the government, like always, they give us benefits, right? They give us opportunities. They give us things, but then they say, oh, time out. Let me put a limitation on that. Okay. And so they come up with that number. We're not going to talk a specific of that number because we don't know what time frame you're watching this. So what you can go ahead and Google and research is my defined benefit contribution amount or my income amount. It'll pop right up. What will happen is that's the number. So what the formalization looks like is my age, assumed period of retirement years. So they're going to use, most of the time, they're going to use when the average male or female passes, right? So they're going to use the Social Security numbers basically on that. So let's say it's 20 years. And they're going to use that dollar amount, that maximum you're allowed to take out. Okay, so let's just, for talking purposes, say it's $200,000. So you're going to have $200,000. My retirement age is 65. Okay, and let's say I'm 55. All right. So 65, I'm going to take 200,000 out with an assumed rate of return. So the actuary
200,000 per year.
What's that? 200,000
per year.
Yeah.
Okay.
Yeah. So what the actuary is going to assume is a actuarial rate of return. So they'll use 5%, 6%, whatever they feel like is an appropriate number for that 20-year period. that is all going to give us the balance amount that we're contributing for. Okay. What I mean by that is, so I'm 55. My retirement age is 65. I have 10 years to get to this number so I can have $200,000 a year at an assumed rate of return for the next 20 years. Okay.
So
that's
if we just,
what an annuity does.
Yeah. So let's just look at that. So 200,000 divided by 0.05, let's say, for example, is $4 million. So we need to accumulate over this 10-year period $4 million. If you did that evenly, that's $400,000 per year that you would contribute to the defined benefit plan. And that would kind of accomplish the goal for which you set out.
Yeah. Yeah.
That's the idea.
From a high level number.
Really
correct.
high level. Okay.
So now you have 10 years. And so you're making those contributions. Okay. And so you're putting 400,000 to your calculation in. Okay. Now, what kind of defined benefit plan? Well, those numbers are going to change. So if I'm allowed to put 400,000 in this year, and what if my balance does 20%?
Mm-hmm.
Well, what happens is my next year, I actually will be able to put in less, because if I keep putting in 400 and my balance is 20%, I'm going to go beyond that calculation.
Oh.
That number. Right?
You lose your ability for quote unquote write-off going into it as it grows, potentially.
Correct.
Interesting.
So here's the two sides of the scale. Am I doing a defined benefit plan for a tax purpose,
mm-hmm.
or am I doing a defined benefit plan for a accumulation purpose?
Mm-hmm.
Okay. Now, I will talk about the different types of defined benefit plans to address these two options. Okay. So, but from a general perspective, the traditional defined benefit plan, that's how it's structured. Okay. Now, if I'm 45, well, I got 10 more years
mm-hmm.
to be able to contribute. So my contribution amount will be less. Also, because I have 20 years to accumulate at a certain assumed rate of return, that will adjust that ability.
Mm-hmm.
Okay. So this is usually the first strategy most financial advisors and or CPAs will recommend for a high income physician. Okay. Because more than likely you're already putting money into a 401k, profit sharing, or something to that effect. Now your income is at a point where you're like, oh my goodness, this is crazy. My taxes are nuts. And so the CPA says, oh, taxes are nuts. Okay, well, you should do a defined benefit plan. I got a guy. Right? Or call your financial advisor. Okay. And then so they'll calculate it all out, which I'm not saying that's a bad thing, but the reality is why are they looking at this? For a tax deduction. But what are they also doing? Joe, you've heard me say this multiple times in these conversations, is that they're also tying up capital into a retirement account that they are unable to touch till they hit that retirement age. Okay. So
is it as identified in the defined benefit plan? That's when they can, so it's kind of, they set the rules for themselves.
Yes.
And then have to live by those rules.
Now you can amend those rules, meaning that you can decide to move your retirement age a little bit farther. Then you have to do an amendment to the plan documents, right? Your third party administrator, the actuary, everyone will come in and put in all these numbers and say, okay, here's what you're able to do now. Okay. But that means that you're not able to start taking money out until you hit that retirement age. And the vice versa too. You can say, oh, I had it originally at 70. I want to drop it to 65. I'm done. I'm done doctoring. Right. So I only want this period of time of me doctoring so I can finally retire, get done with this. Okay. But just like with traditional retirement accounts, that income that is taken out of these retirement accounts are going to be all taxable. Okay. And so there's the issue is, do I want to have ordinary income taxes into retirement? Do I want to have my capital tied up into this thing? It's an asset. I'm not saying it's a bad thing. I'm not saying that's not a good option. I'm just saying this is how the rules work. So if you're a doc who's looking for tax benefits, not necessarily accumulation, then it may be a good option. But do you also want this capital that you're tying up to be able to go into other potential assets?
Mm-hmm.
Right? So these are all different things that should be part of that equation, that conversation. And a lot of times it's not. Now, that's a traditional defined benefit plan. So it's a nice asset. It's kind of for us, depending on the client situation, it's usually one of the last resorts because of the tying up capital and the lack of liquidity. That's the concern. But that's why you get the large deduction. That's why it's tax deferred, right? So, but all of that's getting deferred to when you start taking it out.
Mm-hmm.
The other issue is that if you are doing it for tax benefits, to our point earlier, if your advisor or you or whoever picks the returns, or you just close your eyes and just put it all in the S&P 500, you earn a great rate of return. Next year's contribution is going to be lower. Now, what are you going to do for tax benefits? Right? That's why these plans shouldn't be designed because of a tax benefit. It should be designed because you want to save up money for retirement in this asset, because that's what it is. It's a retirement account. Okay. So that's the traditional defined benefit plan. And because of your comment earlier, Joe, is if it goes up, right, then what happens is your contribution the next year goes down. So there came out a plan called a cash balance defined benefit plan. All the rules are the same except for the investment. It's no longer going to be in equities, so to speak. It'll be in cash equivalent assets, which is why it's called a cash balance. And we're going to use a lower assumed rate of return, maybe a 2 or 3% contribution or accumulation. So that means what happens to your contribution? It stays level at the amount that you have planned for your tax benefit. So this is a plan that a lot of tax advisors, when I say tax advisors, I use that very loosely. That means a financial advisor who says they're a tax advisor. And this is their tax advising, is doing a cash balance plan. Again, not saying it's bad, just saying that's how these rules are. But you consistently have a contribution, so therefore you consistently have a deduction or reduction of taxes. Okay. So, and again, it works the same way. You're tying up capital, right? Now, here's the thing that blends these different plans together. You can do a plan where you can add a 401k, safe harbor, and a profit sharing. Now, we didn't talk about safe harbor when we talked about 401k plans. Okay. What a safe harbor is for a 401k plan is a plan design that the government said, hey, you high income earners, because they got to do testing of high income earners to balance out the contribution amount for rank and file and high income earners. Why? They don't want it what they call top heavy. What's top heavy mean? The higher income earners are putting more in and the rank and file aren't. Okay. So the top heavy, the higher income earners are only allowed to put in a certain amount based on what the rank and file are able to do. Okay. Now that's a traditional 401k plan. So what a safe harbor is, it says, hey, you can max out your contribution. Okay. Your defined benefit and the amount, your defined contribution, meaning what's coming out of your paycheck. Okay. And I should say, the company's contribution. So you can max that out, but you have to, as a company, match or give funds to your employees. Okay. And that's what the actuary will do. He'll put out the census, put out all the incomes for all your people, the people that have been with you, within the guidelines of how you design the plan. So anybody who's after a year employed has access to it, right? And the other thing is it's completely vested. Okay. So what happens is that and then you can create investment schedule. Excuse me. Got all these things going through my head and I only have one mouth, but I want all these things to come out at the same time. So sorry, my tongue's starting to twist over here.
So you're saying the company's contribution to the employees is vested immediately in a plan like this?
Typically. Okay. And the reason being is because the government's saying you can max out. Now, there are certain plan documents where you can do a vesting schedule. Okay. But this is designed for safe harbor, is designed for the high income earner, the top heavy, to be able to max out. And so what the government says, you can do that, but give everybody else money too. Okay. And so that's the kind of the structure from a profit sharing, a matching on the 401k. So the actuarials will go through these different plan designs. And so what'll happen is that a financial advisor will say, oh, okay, here you go, doc. You get 85% of the contribution. The other 15% is going to go to everybody else. So what's your cost? Your cost is 15% for you to get 85. Okay. Now that's based on current. Because now once a plan's in place, plan's got to stay in place. So if you're a practice or a business that's growing or you have plans to grow, this actually may not be a very good fit for you. Because your contribution, your defined benefit, if you add a cash balance plan to this safe harbor plan, which is what I was getting to when I brought this up, is that you also have to give money to your employees within the cash balance plan.
Is that automatic, or is that something that employees have to like opt into and then they're part of it? It's an automatic, like they get it.
They get it.
Mm-hmm.
Okay. And so there's different plan designs and all this kind of stuff. So again, we're just doing high level. We're not getting too much into the weeds to exact numbers and stuff because everything is different. But my point is that if you commit to this, you commit to this. So there's going to...
Let me ask the really, like, in my mind, really obvious question is, crap, I set this up. I was sold this plan. I don't think this is right for me. Now what?
Yeah. And so let me get to that answer in a second.
Okay.
So if you're a practice where you know you want to grow or you want to thrive, but also think about over a period of time, and this is where inflation is a killer to these types of plans, and depending on where your practice is at, the inflation in your local area is going to be different than the country inflation. So if you're in a big city, like, you know, someplace like LA or New York or Chicago, where the cost of living's higher, right? And you have employees, you're going to be put in a position to where you're going to have to give more money in employee income to your employees. Well, your contribution amounts are percentages based on that. So your contribution is going to be forced to go up. So your costs and your expenses are going to be forced to go up. Okay. Now your contribution is still based on that defined number. So you may not benefit. So right now you may be getting 85%. In 5 years, it may drop to 80%, 75%. Right? Now, again, this is all based on specifics to that business, that census, right? The type of design, all that kind of stuff, but just from high level, things that we got to look at and and understand. So to your point, Joe, oh crap, I wasn't told this. We're contributing, we're putting money into this. And now that I think about it, Bob, you know, we've been doing this for 5 years, and I do feel like our contribution continues to go up and we're committed to this. And what's our exit strategy? Well, you can exit, but like with most things, you need to know your exit before you take the entrance. You have to have an exit in mind to understand before you move forward. Okay. And that's very important. So it really depends on what you're using as investments, what you're using as a structure for this. So if you're using an insurance company, they may be using a group annuity. So there could be deferred charges if you shut this down earlier than those deferred charges. So you could lose assets because of that. There's certain periods of time where you do have to file documentation as to, hey, we want to shut down the defined benefit plan, but you also now have to have an actuary. So you have the costs in the actuary saying, okay, which amounts are allocated to which employees, and those amounts got to get distributed into the employees, either their 401k numbers, their 401k account and balance, or if you're shutting the whole thing down, it not only goes to the employee, but now do you have to have conversations with each of the employees of how to roll each of these over into their own traditional IRA. And you have to have documentation to show that the employees are getting it. So let me kind of explain what I just said and what I mean by that. If you're shutting this down, what the government's going to want to make sure, the IRS is going to make sure, is that you're not putting this plan together, save money on taxes. You created this huge asset and then you shut it down, and then you don't give these assets to your employees, you keep them yourself. So this is where the IRS is going to say, hang on, time out. A lot of times, not every time, but a lot of times, the IRS they have a separate pension division. They will audit the pension to verify that the funds were reallocated to the employees and they got theirs when you shut the plan down.
Mm-hmm.
Okay. Why? Because ERISA laws, these laws are in place to protect the employees. The safe harbor, the structure is, yes, to give you an opportunity to put more money into it, but it's also allowing you to do that by you taking care of the employees. So they want to protect bad actors by protecting the employees. That's completely realistic. Okay. So, and the reason why I bring this up, we had a situation with a particular client that they were being audited and having conversations with the auditor. They wanted a plan document. They wanted all these paperwork. And we're talking about thousands and thousands of pages. Okay. So I asked the auditor, what are you looking for? What are you trying to make sure that actually happened? And very sweet lady, totally overworked. You can hear it in her voice, but she basically said, this was after a few emails back and forth and sending documents and all this kind of stuff. She finally said, Bob, we just want to make sure that the employees got what was owed to them. So I said, okay, I can send you these thousands and thousands of documents. You can go through all these. You can ask for more documents. I can go and give those to you, and we can extend this for a few more months if you'd like. Or can I give you official statements from the company, the investments, before the shutdown and after the shutdown, so you can see the balance of the employee's balance before and after?
Mm.
Would that be okay? And would that satisfy you in what you guys are looking to accomplish? She said, yeah, that'd be really easy. I said, it would be for me as well. Right? But to your point, you want to make sure they got theirs. And I totally agree. So I want to give you that proof. So literally, it was 2 statements. One before, one after, right? With all the list of the employees and each statement for that. We sent it off to her. Done. Good. Thank you so much, Bob. Done. So a lot of times when you go through these, it's really about, what are you looking for? How can I help you? Right? Because the doctor, you aren't really going to know all this. And sometimes some advisors aren't going to know this as well. Why are we going through this? Right? Because we're being audited. It creates this extreme fear. Oh my goodness. And they send you a letter with, literally, it was a 3-page letter with all these documents because they want all these documents. And so it finally dawned on me, you're doing this to make sure through our conversations, the employees were taken care of. So let's have a solution, right? So that is essentially why a lot of times these plans get in place. There's a lot of questions that should be answered and asked in a design in the very beginning. Okay, it's not just about how much you can put away and what your tax savings is and what percentage you get to keep. It's the longevity of this. It's what your practice is going to do. Do you have other partners? Is your age? Is this something you want to do? Do you have other income streams? What are you going to do at retirement when you have these 4, 5, whatever $1 million of taxable income? Do you have some kind of tax plan in retirement to address the taxes because you no longer have your practice and the deductions in your practice? Now all your income's taxable. Right? So there's all these variables that have to be discussed in putting something this complicated or this much of a commitment in place. Right?
Well, and I think any business owner, I think that would be tough. I think that's tough to commit to that, especially, if a doctor is listening to this who owns his or her practice and they have any aspirations for growth. In my mind, I would find it really difficult to ahead of time lock up that much capital or really any capital on an ongoing basis.
Mm-hmm. Yeah. And different people that we've talked to, Joe, that you and I've been on calls before, right? This is a big issue.
Mm-hmm.
And there's a couple that we've had conversations with, amazing human beings, just wonderful human beings, didn't have this conversation in the beginning. And they're now coming to us and saying, hey, I have a cash flow issue the 1st of the year because I had to make this huge contribution that I was required to do
Right.
because I signed these documents. Now what do I do? Right. And so the simple question we had for this particular member was, well, are you in growth mode? Are you trying to build your business? Or are you satisfied? You're going to rest on your laurels type situation. He's like, no, we're total growth mode. We've only been in business, 2-3 years. We're looking for this, and this, right? He was very excited and animated about their plans. And he has done exactly what he has said. Right. A year later. I mean, he's done an amazing job just because he is a good human being. And so that, he's being rewarded for that just besides his skills. But we're now in this conversation again, a year later, having this cash flow conversation. What do we need to do? How do we need to do it?
So let's talk about the darker side of this is, so what's in it for me, for the advisor, right? So why, and maybe sometimes it's just because all you have is a hammer, everything looks like a nail. So the second somebody talks about taxes, they're like, oh, I can help. I have a tool that helps with that.
Yeah.
They may not even know the full ramifications of this because all they have is the hammer when that, thing that looked like a nail popped up. So what do the advisors or the people who are quote unquote selling this defined benefit plan, what do they get from the whole transaction?
Yeah. Well, they get paid, obviously, right? So
like what? How much do they get paid? How do they get paid? Like, how does that function work?
Yeah, it depends on how it's being structured or set up. So if it's inside of an insurance product, they're going to get a commission based on really insurance commissions. Some of these plans, defined benefit plans, they'll put actual life insurance inside of it to jack up the contribution, the tax savings, and the life insurance is sitting inside. And then that's a whole nother conversation on how you exit out of that, right? How do you get the life insurance out of it? But that adds an additional commission to the advisor if they're insurance licensed. If it's just an AUM play, meaning they're just doing investments and managing those investments, then it's going to be fee based. So you're putting in $300,000-400,000 a year. Then they're managing that $300,000-400,000 a year as it grows to essentially goes to their fees, right?
Right.
So
you talked about and you talked about like an annuity, like there might be a group annuity in it where it's like, and you talked about like paying that off early, and there's going to be surrender charges. Well, it's like, how did those surrender charges get started? It was the commission that was paid to the salesperson.
And I would say that I personally don't think a insurance product in a retirement structure like this should have surrender fees. I don't believe that that's allowed. Outside of it, when you're doing this individually to buy an annuity and you're discussing that individually, but none of the participants are in that conversation, just the business owner. They're the ones setting up the plan. Right. Even if it's just a doctor setting up for him and himself, most of the time, it doesn't allow you to actually hold that institution accountable for not performing the way they said it would perform. Right. And so all of a sudden now you're hindered, you're handcuffed as a client because of those costs of the surrenders. So I actually think there should be some form of regulation on that does not allow it. They should have non-surrender fee type products, which is very easy for an insurance company to do. You just lower the commission, right? You lower the cost on the front end, right? So anyways, that's my own personal opinion, but at the end of the day, Yeah, advisor's going to get paid, and you're going to have a third-party administrator, so you're going to have that cost as well. Some of them charge flat fees, some of them charge a percentage based on the assets in the plan. So now you're paying an advisor, you're paying a third-party administrator, depending on the company of the custodian and the platform. There's going to be fees associated with that. So people have to get paid to make this thing happen. So, but those are all part of that dialogue and conversation of, okay, we're doing that. So there's a cost that, hey, doc, you get 85%, but you're also getting all the costs associated with the plan.
Right.
So your contribution is 85% of the contribution, but besides the 15%, you have other costs associated with that.
Right.
So again, these are just rules, right? This is a lot of information in a short period of time. But that's the goal of this, is to ask questions, jot down questions, make you think. We didn't go totally into the weeds of all of this, though it may feel like we just did, right? But that's new information, right? The idea is we have to understand why we're doing what we're doing. Again, remember what we've said in most of our episodes, that taxes are a symptom of a core root cause. And that is your asset. What kind of asset do you have? And that asset is what's going to create the type of income that's going to create the type of taxes. Okay. This one's just deferred. So that's the carrot, right? And so do you want that? I don't know. Maybe it's a great fit for you. That's awesome. Then do it.
Having someone who can actually step in and give sound advice and guidance on this is really important. And I remember, having in a previous life talking with a lot of people about this, they just bought various insurances as they went along with no idea. I mean, honestly, they had no clue. Candidly, if you ask most insurance agents, how do you get paid? They may not even understand, like it, some of them will get paid 100% commission. 100% of the money that comes in goes to them. How does that function? How does that work? And they don't understand it. So my point is, like, it's good to have a team who is knowledgeable from a holistic perspective, take a look at everything that's going on, every insurance that you have, and say, does this even make sense anymore? But have a team that's knowledgeable and really looking out for you, who has a fiduciary duty to you, not to, so that they can make money, but so that you can be whole. So I think all in all, may today be the last day that you live in this world without that kind of input and advice and guidance. So if you haven't already, I highly encourage you to reach out to our team at Terra Firma. This is why we exist, is to help you make smart choices about what you're doing with your money, so that you can not only experience the values, the things that are important to you, but also build your wealth in a peaceful way.
And who Bob is on this podcast, giving all this knowledge, is exactly who he is on every call with our members. And I say this to so many people, he's just so generous with the educational part of it, and like, oh, this is what we're doing. It's like, this is what we're doing and why, and it's how it's going to impact both your taxes and your wealth. And I think our members just get so much value along the way, not just because we're saving them on taxes and helping grow their assets, but like, they're learning so much along the way. And I listen to these things and I'm like, this is overwhelming. Like, okay, I'm contributing to a 401k and an IRA. And should I do a defined benefit plan? But which one? And how much? And it is a lot. And so like you said, Joe, you need that more holistic approach and the big picture plan to make sure it's all working together for you to reach the goals you have. So Bob, thank you for always being so generous with your knowledge. Doc, we hope you gained a lot of value from this. If you did, please hit subscribe, share with your doctor friends. We love having you here. And until next time, go be a Wealth Maverick.